Caleb, you said that you're going to maybe move some weight into your long-term portfolio into stocks. Are there some names that you could bullish on for kind of the long term there? I think one of the names that I really like that's kind of underbought right now is Amazon. Is there anything that sticks out to you that you'd be willing to share?
I'm happy to share. Definitely subscribe over to my Substack. So one thing that I've overall been doing is I've reduced my exposure to some of the names that have just really gone exponential this year. So I sold my entire position in NVIDIA.
Okay.
And another semiconductor company called Lam Research. Both of these stocks, when I sold them, were up 83% and 100% since the lows in October. And so when you have stocks that move up that much, I was underwater on them because I was just dollar cost averaging during a bear market.
Yeah.
And so I had an opportunity to get out at a profit. And I think the stocks are overextended. That doesn't necessarily mean that they can't keep going higher. They definitely could. And I'm prepared to watch them move higher.
Yeah.
But after such a substantial run for something like NVIDIA, I felt like it was a good idea to de-risk. So what am I buying? Two stocks that I've already been buying that I increased my exposure to. Let me share my charts on this as well, because it'll help to provide some context overall. One of them is Google. With the resurgence of Microsoft right now, everyone seems extremely bearish on Google. I was very impressed with their earnings report, even though they showed, decelerating growth rates overall. The thing to keep in mind here is with Google, and look, tell me if I get too granular, but the company has $20 billion in cash and over $90 billion in cash equivalents. What are cash equivalents? Short-term treasuries. So maybe 6 months, 1 year, 2 year treasuries.
Yeah.
And so they're generating a pretty solid yield on that, and they have $90 billion worth of it. And I think if I remember correct, they have about $15 billion in long-term debt.
Mm-hmm.
So if they wanted right now, Google could pay off all of their debt and have, excuse my language, but a shit ton of money left over to survive a recession, to invest in R&D, anything that they want. So, please show me any company right now that basically has $120 billion in cash, because I'd love to be buying that stock right now. Google meets that qualification for me. And so I like that kind of defensive position. And look, keep this in mind, right? If we go from the 52-week highs to today, the stock is down 38%. For it to make new all-time highs, right, the stock is going to need to gain 62%.
Wow.
Right? If that takes 3 years for that to happen, and I need to, sit around for 3 years before the stock makes new all-time highs, but I gain 62%, I'm basically securing a 19 or 20% annualized return, whereas the market historically is going to give you 8 or 9%. So you're more than doubling the historic average gain for the stock market by buying Google today. Does that mean it can't go lower? No, I expect it to go lower, but I'm still going to be buying the stock, right? So Google is one name that I'm buying. Yeah. Another stock that I'm buying, Republic Services Group. Most people are going to have no idea what the hell this company is.
I don't.
But I guarantee you, they service most of America. What are they? They're a waste management and collection services company. So they're a utility stock. They pay a small dividend of 1.5%. It's nothing great, but it's enough. Let's zoom out here, okay? Let me get rid of these corporate actions down at the bottom. Let's look at this on a weekly chart for as long as we can.
Wow.
Like this looks like Microsoft. This looks like Google. This looks like Apple. And what do? They're doing nothing innovative. All they're doing is stopping by your neighborhood and picking up your trash.
Yeah.
Right? This stock is a massive, massive compounder over time. And it's surprisingly defensive because it's a utility stock. Utility stocks often provide a level of defense and protection within an overall portfolio because they're going to pay you a solid dividend. They have very stable cash flows. They don't really grow very much.
Yeah.
They're just steady performers. And guess what? Trash isn't going anywhere anytime soon. If anything, as the population grows, trash and their fundamental business is going to grow over time with demographic trends. Yeah. So this is something to watch. You'll also notice the stock is actually negative year to date, even though the broader market is up. So as I look today to allocate money, I want to allocate into things that are technically underbought relative to the market on a short-term basis, especially when the long-term chart looks like this, right? So RSG is something that I've been buying. Now, I teased that I'm buying 2 new stocks for the first time. One of them is Extra Space Storage. They're the nation's second largest self-storage real estate investment trust.
Oh, cool.
So Public Storage is number one. They just had a pretty big merger or acquisition of Life Storage. So PSA is going to be the largest by far. But this company pays like a 3.5 or 3.6% dividend yield. They're down substantially from those all-time highs, right? The stock is down 29% from the all-time highs. I started buying them at the beginning of the year, but I bought more shares again last week. Again, I'm just building out this position over the course of the last month and a half. So very new position for me. But again, right, look at the long-term performance on this sucker. It looks, again, like a tech stock over the long run. Yeah. I mean, even if we just rewind to the beginning of 2014, the stock is up 290%. So what is that, 3.9x? Yeah, exactly. It's 3.9x. So that's a massive return over a 10-year period. You just almost 4x'd your money. And they pay you a fantastic dividend. So I love Extra Space Storage. They're still growing at a really solid rate. They have earnings coming out, I think, this week or next. So I'll be certainly watching for that. I'm also buying another real estate investment trust, DLR. This one's super interesting to me. It's a data center real estate investment trust.
Okay.
So they lease out buildings that have massive servers for companies to tap into for cloud, for internet, for whatever the case is. So if you like technology over the long run, you know for a fact that we're going to become increasingly reliant on data, on cloud, on internet infrastructure. And this company owns real estate properties that do exactly those things and set up the infrastructure. Mm-hmm. And they pay a massive dividend of like over 4%. That's
awesome.
So I'm going to get those dividends reinvested into buying more shares and allow this sucker to compound over time. The long-term chart, I think is really good. It's nothing spectacular. You'll go through a lot of chop, but if I have the opportunity to reinvest dividends and, I can increase my wealth by 4.5% on an annual basis by buying more shares, I actually want this thing to go sideways or dip a little bit because it allows me to accumulate more shares for the long run. So I'm happy to sit in this. Again, these are long-term positions I expect to hold for the next 5 to 10 years, ideally. And I might sell some in this time and sell some at that time, but I plan to continue buying these things over the next 5 to 10 years.
Absolutely, dude. Big ups. I really appreciate you sharing those. For those of you guys who don't know, Caleb just gave you guys some very, very good tips right there. Not financial advice, but definitely go check out. He is the second link in the description is Caleb's newsletter. Definitely go check that out. He's got a free one, so you can subscribe to that and kind of see the sauce that he's working with.